I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Then we're going to take a look at a walkthrough illustration of how to properly utilize the accounting equation in order to analyze transactions. If you have any uncertainties about how to analyze transactions, I provided a link of a video that could get you up to speed in no time. So without any further ado, let's rock and roll. So what we got here? All right, so it's telling us Elaine's Inflatables earns service revenue by providing party planning services and inflatable playscapes. Elaine's Inflatables is organized as a corporation. During the past month, Elaine's Inflatables has the following transaction. So we got a couple of transactions, A through I. Alright. Indicate the effects of the business transaction on the accounting equation for Elaine's Inflatables. Transaction A is a guide. Use the following accounts, blah, 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 yada, yada, yada. All right, so they give us an example to kind of piggyback off. So in A, they received contributions of $10,000 in exchange for common stock. And the correct answer, increase asset, which account? Cash. And increase equity under which account? Common stock. All right, so here's the deal, gang. I'm a big advocate on keywords. You have to identify the keywords. Accounting is nothing but word problems, but if you just focus on the keywords, they will guide you to the right answers. Most of the time, the keyword is the account. So let's see what we have. B, purchase equipment for $5,000 on account. So keywords, purchase equipment. Equipment is being affected, obviously, and equipment is an asset. So when we purchase equipment, we're increasing the asset. And what account is being increased? Equipment. All right, so what are the other keywords in this transaction? On account. So here's the deal, gang. When you're looking at these keywords and you're trying to identify, you find out the word on account is a keyword, two accounts should pop in your head. Either accounts payable or accounts receivable. They're quite different. Why? Because one account you set up to receive cash in the future, whereas the other account you set up to pay cash in the future. Now clearly we know which ones is which. But what you need to understand is that anytime you're receiving cash in the future, i.e. accounts receivable, that's an asset. And if you are expected to pay cash in the future, that's a liability. Remember, gang, any liability that has the last name payable must be considered a liability.
Sensational.
So, on account, we're purchasing equipment. Obviously, we made a payment. So we have to set up an account to pay in the future. So, we're going to increase a liability because our payables are going up. Our liabilities are going up. We owe more. And so what account is it? Accounts payable. Let's check the answer. Bada bang. Let's move on. Paid $400 for office supplies. Easy breezy, gang. Anytime you see the word paid and the company in the transaction actually made the payment, one thing for certain is going to happen. When you see the word paid, cash is going down. We know cash is an asset. So our assets are decreasing, and it's going to be under the account cash. And the other keyword here, obviously, again, is office supplies. So our office supplies is actually the asset that we paid for. So our assets are going to increase. And that particular account is considered office supplies. We have supplies down here. Let's check that answer. Bang. Moving on. Earned and received $2,500 cash for service revenue. Okay, gang, what are the keywords in here? Earned, cash, service revenue. So we know anytime that we provide a service or sell a product, revenues are being generated. In this particular transaction, it told us that we earned service revenue. We also know that cash was received. So from the asset side, because we're talking about cash, we know that our assets are going up. So we're going to increase our assets under our cash account. Now, since we earned the revenues because we provided a service, our revenues as well must increase. However, revenues affect what part of the accounting equation? Revenues particularly affects retained earnings, and retained earnings is income. We measure income by taking our revenue accounts and subtracting from our expense accounts. So anytime we earn revenues, we are ultimately increasing our retained earnings, directly increasing our stockholders' equity. Remember, gang, stockholders' equity is broken down into two parts. Paid-in capital is the first part, and retained earnings is the second. Therefore, our equity is going up, and it's going up under our service revenue account. Let's check that answer. Bang! Moving on. Paid $400 for wages to employees. Easy breezy, gang. We already identified the keyword paid, and anytime we see the word paid and the company's paid, cash is going down. Cash happens to be an asset, so we're going to decrease this asset, which is cash, by the $400. And the other keyword is wages. Wages happens to be an expense to the company. Expenses to the company also affects retained earnings. Why? Because retained earnings is income. So anytime we have expenses in a company, it decreases our retained earnings. Since it's decreasing our retained earnings, it's ultimately also decreasing our stockholders' equity. So our stockholders' equity is going to go down under what account? Wages expense. So we're going to check that answer. Money all day, gang. Let's move on. Start practicing the keywords. The keywords will always guide you to the correct answer. Cash dividends of $1,000 were paid. What are the keywords? I'll give you guys a second. Dividends paid, right? So, anytime we see the word paid, we know our assets are going down. What particular asset? Cash, right? So, we're going to decrease the asset again, and that account particularly will be cash. Now, what about dividends? Dividends is a separate account that happens to affect retained earnings. How? It decreases retained earnings. Why? Because retained earnings is income. And by definition, anytime the company gives income to the shareholders, then we consider that to be dividends. So if the company gives income to the shareholders, it ultimately reduces our retained earnings balance. And we already know retained earnings happens to be a part of stockholders' equity. So our stockholders' equity is decreasing, and the account that is affecting it is the dividends account. We are cooking with grease, gang. Nice work. Let's keep it moving. Next, earned $1,000 for services provided. Customer has not yet paid. Couple of keywords in here, right? Services provided, not yet paid. Customer hasn't paid. So we provided some services, gang. Anytime you provide services, I want you to have this one particular account ringing the bell in the noggin. Providing the services or selling a product always generates revenue, increasing our revenue. And we know that revenue affects retained earnings, and we know retained earnings is a part of stockholders' equity. Now, it tells us that the customer has not yet paid. So the fact that this revenue is earned, but the customer hasn't paid for the revenue that they receive, means that we, the company, is expected to collect cash in the future. And so anytime we're expected to collect, i.e. receive cash in the future, we must establish an asset account called accounts receivable. Therefore, our assets are going to increase under our accounts receivable account. And as we mentioned earlier, revenue increases retained earnings, which is a part of stockholders' equity. Therefore, our equity will increase as well under our service revenue. See how easy the keywords brings us to the right answers? Good job, gang. Last but not least, I don't know if this is the last one, but we're getting close. Paid $1,000 for rent. Very easy. Keywords, only two we need. Paid rent. Again, anytime we see the word paid and a company is paid, we know cash is going down, decreasing our assets. So that's easy, straightforward. What about rent? Rent that happened from the company's perspective happens to be an expense. So as we know, expenses affect income, and if it affects income, it affects retained earnings. If retained earnings is affected negatively by expenses, ultimately our equity will have to decrease. So we're going to decrease our equity because our rent expense incurred. Incurred is just a fancy word of happening. Check that. Well done. And I believe this is it, gang. So let's bring it on home. Received a bill for $250 for the month utilities. The bill has not yet been paid. Okay, keywords. Utilities. We received a bill for utilities, but hasn't been paid. And utilities is an expense. Now, the fact that we haven't paid for this particular expense that has incurred means that we still owe, gang. And if we still owe, that means we have to create a liability. So we are going to increase the liability. So we're going to just call it accounts payable. And what about our expense that has happened? That's going to decrease our equity. And it's going to decrease through the utilities expense. So let's see how we do it. Excellent. Bada bing, bada boom. So this summarizes, gang, a beautiful illustration of a walkthrough of how the accounting equation is affected by transactions. So hopefully you understand some of this stuff and that light bulb is clicking. And if so, please like, subscribe, and share the channel with your friends so they can learn to chase the bags as well. I'm Dr. Who, and it's always my pleasure, and I'll see you guys soon.